Hi everyone, I'm Carl. Welcome back to the Renko Trading channel. Before we start, this content is for educational and experimental purposes only. It is not financial advice. Always do your own research before making any investment decisions. Today, I want to talk about something we all experience when analyzing charts with trend lines and support and resistance levels. On paper, the idea seems simple. Draw your lines. Follow your rules. Make confident decisions. But in reality, once the lines are on the chart, new questions appear. Doubts creep in. And suddenly, we feel stuck with even more uncertainty than before. So let's walk through a real example using the Republic Services chart. Republic Services has had a really nice long-term uptrend. The stock climbed from the low $100 range all the way up to nearly $260. So let's say we bought shares somewhere in the hundreds, and life was good. Strong uptrend, higher highs, higher lows. No stress at all. But then around $250 to $260, the price started pulling back. And when it fell below $240, we started thinking, is this it? Is the uptrend weakening? Should I take profits? So we draw the trend line. We connect a swing low near $200 and extend it upward. And we notice the price broke below the trend line. This should be a clear signal, but instead of acting, a new doubt arrives. What if this is just a small correction? What if it goes right back up? So we shift to a different tool. We draw a support level using the recent swing low near $230. And we keep holding. But the stock keeps drifting lower. Now it's below $230. Another possible exit level gone. And once again, instead of taking action, we make an adjustment. We look at the recent swing high around $217 and draw another line. Okay, maybe this is the support. Maybe it will rebound here. And just like that, we now have multiple trend lines and support levels. Although the trend lines or the support resistance lines are not necessarily wrong, but now confusion creeps in. Instead of confidence, we have hesitation. Then, the price breaks $217 too. Now the emotional part kicks in. I should have sold at $250. I should have sold at $230. I should have sold at $217. We start waiting for a rebound. We hope the stock will come back so we don't have to feel wrong. We draw even more support lines, maybe around $200, maybe just below $200. And now we are no longer following a plan. We are just trying to avoid regret. Self-doubt has taken over our analysis. So this example shows how quickly without an exit plan can turn into hesitation, second-guessing, and emotional stress. And it isn't because we don't understand trend lines or support and resistance. The real challenge is psychological. Which brings us to the next part. When price starts going against us, our brain shifts into protection mode. We fear taking a loss. We fear being wrong. We fear missing the rebound. So instead of acting on the original trend line break, we draw a new line. We adjust our rules so we can stay in the trade a little longer. And each time we do that, we lose more clarity and gain more stress. We aren't redrawing lines because the chart changed. We're redrawing lines because our emotions changed. And the more we adjust, the harder it becomes to make any decision at all. But there's a way to avoid falling into this trap. The most important decision is not where you buy. It's how you plan to exit. And that depends on two personal factors. Your risk tolerance and investment goal, that could be a long-term trend versus a short-term trade. Some traders want maximum protection and will sell everything when the trend line breaks. Others take a scaling approach like break level 1 sell 1/3. Break level 2 sell another third. When break level 3 exit the rest. There is no right or wrong. But there must be a decision. If the plan is not set before the trade, emotions will rewrite the plan later, and usually not in our favor. And this is where trend lines and support levels become powerful tools again, not for changing decisions, but for confirming them. When you draw a trend line or support level before entering the position, you are defining your risk. You are saying, if price breaks this level, I'm out. It becomes a contract you make with yourself. So when that line breaks, the rule triggered. The plan is clear. You take the action. No new lines. No new exceptions. No hoping for a miracle bounce. If we keep changing the lines to avoid selling, we are no longer analyzing the chart. We are negotiating with our fear. Trend lines are not meant to justify staying in. They are meant to tell us when to get out. So once the process is clear, it really comes down to mindset. Here are the principles that will protect your profits. Have your exit rule ready before you enter. Use trend lines to confirm decisions, not delay them. If your rule triggers, take the action, no hesitation. A small regret today is better than a big regret later. Renko charts help filter noise so you can stay objective. Good habits build confidence. Confidence builds results. We all deal with moments of uncertainty when a chart turns against us. You are not alone. But the more we define our exit rules upfront, the less stress we feel later. When we let our system lead the way, when we trust our plan, the chart stops creating fear and starts giving us clarity. Trend lines and Renko charts can help us stay disciplined and focused on what matters most, protecting our gains and trading with confidence. That's a wrap on today's breakdown. Thanks so much for watching. If you found this helpful, give it a like and hit subscribe for more Renko trading insights. Don't forget the bell icon, and I'll see you in the next one.